whole life is a multi-dimensional asset, and your dollar is working in more than one place. You put $1 into whole life and it's protecting your family. It's growing at a guaranteed rate of return. It's accessible to be leveraged. There's so many components of it that make it a very cool addition to someone's financial economy.
If you are looking to scale your portfolio, you cannot miss today's episode. We sit down with Katie Bargetto, who went from being against investing to acquiring 32 units in her first year. So in this episode, we share the details of the strategy that Katie used, which was overfunded whole life insurance. This is a must listen if you want to get another tool in your toolkit when it comes to creative financing. Welcome back, everyone. This is Liz. Welcome back to the Real Estate InvestHER Show. So excited to have Katie Bargetto on our show today. Katie, thanks so much for being here. Excited to jump in.
Same. Thanks for having me, Liz.
So your journey from initially being against real estate investing to actually scaling from one rental to 32 rentals in just 1 year is really remarkable. So take us back to the pivotal moment or realization you had that shifted your perspective and set you on this rapid path to success in real estate.
Gosh, yeah, that was a crazy year, super fun year. But I think what really sort of escalated us and scaled us was we got really clear about our goals, what we wanted. My husband and I got really aligned as a couple. We found tools that helped us really maximize our dollars and how they were working, and building out kind of our own financial foundation is what allowed us to just really propel forward. So we actually bought our first rental in 2015. And then it wasn't until between 2018 and 2019 that we scaled up. We started the year of 2018 with 1 unit. We ended 2019 with 32 units. And it's because we took that time between 2015 and 2018 to kind of build out this financial foundation, and it felt kind of slow during those years. Like, we like real estate. Why aren't we moving faster? But in hindsight, it was the best thing we did because it allowed us to then go so fast.
I love that. So I want to get into the creative financing tool that you used, because I do think it's so under the radar and not enough people are using that particular tool. Because the name of the game right now is multiple tools in our toolkit to be successful in investing. Before we get there, I want to just jump into what you just said about the 2015 to 2018. I think so often we see people scaling and we literally think it's immediate, right? Like literally, I begin investing on day one or think about it. And then literally the next day I have 50 units, right? We all know that that's not necessarily the case. There was a foundation built. And I love that you said that. So what did you do specifically from that 2015 to 2018? Although you felt like it was a little slow, what did you do to build your financial foundation? What specifically did you and your husband do?
Yeah. So let me talk holistically and then I'll talk tactically. So holistically, the biggest thing was just getting clear on our vision. What did we want life to look like in 5 years, 10 years, 20 years? Were we aligned as a couple? And we weren't. As you mentioned, Liz, I was actually against real estate. I was very conservative. I want to max out a 401k and I'll retire and do all the things that, we're taught to do.
They tell you to do. All the things they tell you to do, right?
So it was lots of conversations with my husband and I. Mike, he was, definitely strategically more advanced than me at the time. So it just, I think taking the time to really get aligned and create a vision for our family. So holistically, that's what happened. And then tactically finding the tools that allowed us to do that. And so the biggest one for us was utilizing overfunded whole life insurance. So overfunded whole life insurance it's a permanent life insurance product, which means the death benefit pays out whenever you pass away, whether it's tomorrow or age 120. But you have these living benefits as well. And the living benefits is essentially a place to store your capital, see your capital grow, have guarantees, and then also be able to leverage that capital to go out and deploy into assets. And so for us, what we realized is we had money sitting in a lot of different places. We had 401ks and IRAs and pensions and savings accounts. And we thought that was the right thing to do by having kind of money spread out everywhere. But what we realized is that that wouldn't allow us to really accelerate this process of cash flow, going from accumulation mindset to a cash flow mindset with real estate. And so being able to consolidate some of those, put it into a vehicle that was really solid, really stable, just a foundational asset that we would have in our lives, and then be able to tap that like a personal line of credit to go put into real estate was tactically how we kind of moved the needle so fast.
I love that. And so, okay, so walk me through a little bit about, overfunded whole life insurance. I know that obviously I've heard of it. I don't necessarily use it as a strategy myself. It's not how my husband and I grew our portfolio. But, just because we don't know something doesn't mean it's not an effective tool, right? It's so often that so many people poo-poo different things out there or creative financing strategies because they just haven't done it before. So I'd love to dive in. What is it? And just the A to Z. So everyone listening, again, this could be a creative financing strategy, as you're growing your portfolio in today's market, because now more than ever, as there's more distressed properties coming on, we're seeing that increase right now. Interest rates are kind of leveling out, although who knows? Even if people are talking about a looming recession, whether there is one, we're in one, we're going to be in one, regardless, opportunities will be around you, and deploying creative financing strategies always will be the name of the game in this business, in my personal opinion. So let's dive in. Talk to us as though I know nothing about it. What is it, and how do we use it? What are the benefits? All that good stuff.
Yeah. Well, so it's like I mentioned, it's first off a permanent life insurance product. So that means the death benefit pays out. Most of us are, when we think of life insurance, we're familiar with term insurance, which, you pay an annual premium for 10, 20 years, and at the end it expires, and it's purely, for the protection piece. With permanent insurance, specifically whole life, it has a cash value component. And so you can structure it in a way where majority of your premiums, what you're funding into it every year, are increasing this cash value account. And this cash value account has built-in guarantees. It grows at 4 to 5%. So nothing crazy. It's not an investment. It's an asset. It has the guarantee component. So you're not in the volatility of the stock market, hoping you don't lose it all. And then you can leverage that cash value. And so the way you leverage it is not actually taking money out of the account, but using your cash value as collateral and borrowing from the insurance company. And what that allows you to do is keep your cash value compounding without any interruption. And over a lifetime, that compound growth is, uninterrupted compounding is the eighth wonder of the world. And you really see that come to life in these types of policies. But you have that collateral, and then you can leverage it. So you're borrowing the life insurance company's money to then go deploy into assets, investments, really whatever you want, because there's no underwriting, because your cash value is collateral. And if you were to pass away without paying those loans back, they're just deducted from your death benefit. So it's a really beautiful personal line of credit. It's an unstructured loan. So again, there's no underwriting. There's no payback schedule. So you're paying it back at your own rate. And that, the beauty there for real estate investors is it works with any type of real estate. We went through a season where we did a lot of flips. So you could pull out a huge chunk of money, flip a project, and, pay the loan off in 6 months. Or maybe you do buy and hold. So you take loans, and then you chip away at paying those loans over a period of years. It's essentially in your hands. And so why this creative financing strategy works so well with real estate investors is because as real estate investors, we need liquidity for 2 reasons. We need liquidity for emergencies with our real estate. Anyone who owns real estate knows that things will go wrong. And for opportunities.
And they do.
I have tons of stories. I have a single family house last year, single family in the Midwest. My make ready, the rehab when a tenant moved out was $20,000. It was just like, and you need liquidity. Obviously, like I hadn't collected enough cash flow in that property to fund $20,000, So we also had a period during COVID where we had multiple tenants stop paying rent. But of course, we're still on the hook with the mortgage. So, things will go wrong. And what we see a lot in our industry is we see a lot of people, a lot of real estate investors wanting to deploy every single dollar. And it's just risky because then you have no foundation. So of course, you want this liquidity pool for the emergencies and you want the liquidity pool for the opportunities because we never know when that amazing opportunity is going to come up. And we have lots of stories around, being ready to partake in those as well.
Let's walk through what you specifically did. So you had your first rental. Tell me what your first rental was.
First rental was a single family house in Charleston, South Carolina. And at the time we were in California. So opposite ends of the coast. That was our very first rental.
And it was a long-term rental strategy?
It was a long-term rental and we self-managed that. So we did not have a property manager. And that was really hard. We had a lot of lessons learned. One of them being we actually really like having property managers. So now most of our units are property managed, but we started with self-managing. And just held on to that for a couple of years.
I love that. If I can just make a quick mention, Inago is a company we do business with, and they have such a fantastic and simple, streamlined property management software that I wish, and I'm sure you wish too, Katie, when you're self-managing, you seriously need an all-in-one software. What I love about it is it's free. And it does everything from streamlining your online rental applications to screening tenants. It's like all in one, very robust, very simple, free, I should mention.
Yep.
And they've literally helped like 70,000 property owners like us, landlords, really streamlined. So I just mentioned that because I think about when we self-managed over 100 units as well at the time. And we dabbled with different softwares, but I wish I had Inago's software, to be honest, especially now because it saves time. So we'll put it in the show notes. We have like a link to just kind of, get familiar with Inago. They're doing such great work with their software. Check them out. You should be using it if you're self-managing and really optimizing property management. But I digress. I had to jump in and say that because the more apps if people are self-managing, and scaling, you need to have apps and softwares that are all in one encompassing and that quite honestly save you time, not increase your time. So I just want to mention that because I'm passionate about it, especially from self-managing.
Agree. That would have been amazing.
Yeah, I appreciate it. So let's go back to that first deal. So you got your single family. So it's a different part of the country. Mm-hmm. So walk me through how you're like, we should be using overfunded whole life insurance, our whole life insurance policy to scale. Like, help me understand that. I'm not trying to be funny, but walk me through that, right?
No,
because I don't know, a lot of people scaling aren't thinking that, right, to get their next deal.
Totally. And it's either people haven't heard about it or maybe they've just heard bad things about it. It's so interesting. Whole life insurance is a tool that's been around for nearly 200 years. Essentially used.
That's crazy.
Yeah.
When I was looking at preparing for this, I'm like, 200 years. That's a long time to be around for a lot of people not to be familiar with it.
Yeah, right. And for a long time, it really was a tool used by kind of the wealthy families. The Rockefellers use it. And I think a lot of people just thought it was just a tool for the wealthy. And now people are realizing that it is accessible to literally anyone, without a major health condition. You can qualify for it. So we found out about it. It was really, really random, kind of through a friend who introduced us to someone who was part of kind of a real estate mastermind group. And they were big into kind of combining this idea of using whole life insurance with real estate investing. And so I remember my husband, Mike, talked to his friend and told him about it. And at first I remember Mike came home and was like, oh, I found out more about it. It's a life insurance thing, so it's probably not for us. And we just put it to bed. Luckily, this friend of Mike's was like, man, you really got to just look into it a little bit more. It's not what you think. And so, Mike, fortunately being open-minded, looked into it, and we learned about it and just how powerful it was in having this essentially supercharged savings account with a personal line of credit. So, it's just one of those things. It's, we came across it very randomly, but it allowed us to kind of shift our mindset into thinking about this idea of a financial foundation, kind of consolidating buckets of money to deploy more efficiently, having our dollars work in more than one place, both in whole life and then in our real estate as we're leveraging it. And so it was really the mindset shift that allowed us to kind of really scale.
I love what you just said. You said it's a supercharged savings account with a personal line of credit. I love that. I think when you put it in that terminology, real estate investors get it. Because quite honestly, if you are deploying your own cash, where are you getting it? You're getting it from your savings account. You're getting it from different, whether you sold a property or, you've saved up the money, right? To do that first deal or that second deal, third deal. But where is it housed? Like, where's that money sitting right now? And I think that's such a very powerful way to say it. So if you're not using that in your marketing materials, you should be using that. But I think that's a really simple way to say it. So you have your first deal, you have your first property. Did you already have the whole life set up, or at that point did you set it up and start to consolidate all these multiple accounts?
Yeah. So in 2015 with our first property, we did not have it. We hadn't heard about it. I had actually been building a savings account. I wanted to buy my next car in cash, which now I'm a proponent of financing, finance it all. But before, when I was anti-real estate, max out my 401k, pay cash for my car. So I had built a pretty big savings account, and Mike is the one who convinced me okay, you could buy the Forerunner that you want, or we could buy a piece of real estate and it could produce cash flow for the rest of our lives. And, he kind of mapped out the equation, the financial equation, and I got on board. And so that's actually what we used to buy the Charleston house. And then it was in 2018 when we found out about whole life, got that set up, created this supercharged savings account, personal line of credit. And then really started tapping that for down payments on the single family houses we were buying.
And then, so what I want to know is how much money specifically did you have, if you don't mind sharing, did you have in that supercharged savings account, which I love now, I'm going to be calling it that, to deploy into the next few properties? So talk to me about numbers, because these are real estate investors. So you got your first deal, you have your supercharged savings account set up with whole life. How much money then? What was your next move? Was it one deal? Was it multiple deals? And how much money did you pull from? It's not pulling, you're pulling it, but it's you're going to be replenishing it is what I'm leveraging it. Exactly. Mm-hmm. Which I hear. How much money were you able to pull into one or multiple deals for your next kind of big move?
So the way whole life works is you essentially can access roughly 90 to 95% of what's in your cash value account. So that's what you can access. For us, we didn't want to pull that much money because we wanted to have this liquidity pool. This was our emergency fund. Again, we didn't want every single dollar deployed, because then when emergencies happen or opportunities happen, you have no liquidity, and liquidity is so powerful. So what we did was we figured out what we wanted that sort of threshold to be of, okay, this is money we don't touch unless the world's on fire,
What percent did you go with?
Well, it varies with we kind of do a percentage of our net worth is how we decide how much we want to keep in this liquidity pool. And so for buying the single family houses, we still use bank financing, but we pulled the down payments. So we were buying in the Midwest. And so at that time they were, $100,000. We were pulling $25,000 for a property for that down payment. And so we did a couple of those. We had a little bit of cash that we didn't have in our whole life policy. We deployed that first. And so that's kind of how we started. And then, of course, as we scaled, we used more than whole life. We started using other people's money, all of those things. But having that whole life liquidity pool is what kind of allowed us to always be able to partake in opportunities and, afford the big emergency expenses when they came up.
If I was to play devil's advocate and say, okay, I get that. Instead of having to put it into, a policy, because there's certain things you can and can't do, right? With anything. Instead of doing that, why wouldn't I just keep it in my savings account? And that way it is my own line of credit. It's my savings account. I don't, I don't necessarily have to be beholden to any sort of rules. What have I said that? I'm sure you've gotten that. I'm curious, what would you say to that, especially in today's economy?
Yeah. The biggest difference is that when you then use money from your savings account, say it is even a high yield savings account, when you use that money, then you're only getting interest on what's left. Whereas in a whole life policy, you're never actually debiting your own funds. You, of course, can withdraw later in retirement years if you want. That's a whole nother topic. But when you're leveraging the policy, you're not taking any money out. And so what you have is uninterrupted compounding. And that mathematical equation is so powerful. And so every year you're building on what you've put in, regardless of what you're leveraging. And so that, that's one of the main differences. But on top of that, whole life is a multidimensional asset. It's not a tool you get for the rate of return. It's a tool you get to have this foundational asset. A permanent death benefit. There's so much you can do with a permanent death benefit. You have the protection piece of it. You have the line of credit. You have these guarantees in place. And so it's so much more than just a savings account or whole life.
Yeah, but the tool has multiple kind of results, if you will. So I love that.
Yeah, and your dollar is working in more than one place. You put $1 into whole life and it's protecting your family. It's growing at a guaranteed rate of return. It's accessible to be leveraged. There's so many components of it that make it a very cool addition to someone's financial economy.
I love that. So are there any disadvantages? Are there any things that, folks listening are like, all right, this is a no-brainer, even just what you described on the leveraging, right? I versus if I was to use my savings account versus this, and there's a lot more to it, right? A lot more benefits that you're explaining. That in and of itself makes financial sense, right? To someone who's listening, like, okay, that's a no-brainer. But tell me about the disadvantages. What are the disadvantages that listeners need to be aware of, the drawbacks, disadvantages, or just, blind spots that can happen with this particular strategy? Because like anything, right, we have to be mindful of the pros and the cons so we can make, the right decisions for our family and where we want to be, financially.
100%. Yeah. When we think of leveraging, the thing to remember with whole life is you do have an interest rate. So you are taking a loan out. A lot of people think, or they've been mistold, that you're leveraging your own money, and that's not actually true. So when you pay interest back, it's not going back into the policy. You're actually paying interest back to the life insurance company because you've been using their money. And so I think just ensuring that you understand there is a loan rate involved when you leverage it. And then, I think this tool is not for someone who doesn't have good financial intelligence or discipline, because it's very easy to put money into a policy and then leverage against it, take this big loan, and then not have a payback plan. And then you've essentially diminished your liquidity pool. And so for folks who have like a lot of credit card debt, like we typically won't work with them because it's not, they don't have the financial discipline that you need. Because it's a tool. A tool is a tool. If you use a hammer wrong, you're going to get really hurt. If you use a whole life policy wrong, you can get hurt. And so having the discipline to create your own plan of, okay, I'm going to leverage it for this purpose, and this is how I want to pay it back to rebuild that pool. This is how I'm going to save for premiums. You want to have all of that savviness. And if you don't, then it could not work for you.
I love that, what you're saying about financial discipline. that's so key, because if you don't have that, no, even if you raise money, you partner with people, you get a private lender. I don't care what subject to whatever the creative financing strategy you do. The financial discipline is number one. So I just want to mention that because I can't stress that enough in the 17 years I've been investing. I wish I had more of that when we started,
And all of those, and whole life is just another tool, like everything you mentioned. And they all can work similarly, but you have to utilize them correctly.
When you talk about, I think that's great. I appreciate you sharing that. The payback plan. So I'm curious about your growth, right? You had said, 1 to 32 units. I'm sorry, homes, if you will, properties. You leverage different strategies, but that kind of the whole life insurance was one of the key tools that you used to propel you. So I'm curious though about, did you get into certain deals that you were very clear on how you're going to pay back? Meaning, if you get into a property that there's maybe not as much value add, you may not be able to refinance. That might be harder to pay back, right? I mean, I know that because I bought a rental with a line of credit early on, me and my husband, and we didn't have a great payback plan. Now, we didn't lose the money. We sold the building eventually, but it took a while. It took a lot longer than I had anticipated early on because we didn't buy low enough and really bake in the refinance and really be strategic with that. So was the property choices you made in terms of in the scale that you had very focused on how you were going to pay it back, and it was more of a value add type of properties? I'm just curious about your real estate investing strategy using this tool.
Yeah, so that was most of our investing was really buying for cash flow. So making sure the numbers worked with cash flow so that we could pay it back. And so to buy with cash flow, yeah, typically they all were value add. We did rehabs, and you get better and better, right? Your crews get better. You get better at how to communicate what you can do and can't do. But we did the same thing. We bought a lot in the Midwest. That was kind of our bread and butter for a long time, was just kind of Midwest real estate. And the cash flow was there. We were able to, refinance them and, pull some money out as well, which was great. But the cash flow it was never as good as it was on paper. And so we actually ended up selling a couple of those homes because they just weren't producing the cash flow that we wanted. And so we sold some of those. We repositioned some of that capital into syndication deals, just as LP limited partners, because we kind of liked that cash flow consistency a little bit more. So it's the same thing. And, I think it's okay to kind of change your real estate strategy, and dabble in different things to find out what really works for you, for your finances, for your payback plans, all of that.
Especially right now. I mean, I think cash flow is always the name of the game that so many people want to invest in real estate. Some people are doing it for retirement, where they're just, they're not as attached to the, not that they want to lose money, but they don't necessarily need or want the cash flow right now. Other people are trying to replace their income because they want to leave their job. They really want to transition. So that cash flow is key, right? Is critical. Have you found that using this tool now, especially with interest rates being higher, a lot of people are complaining about deals penciling out, especially on like the single family, the small multis, even large multi. So I'm curious what you're like, how you're seeing this tool be used now, especially when people are complaining and frustrated with not being able to do as many deals as they want because of the lack of cash flow, the lack of return they're going to see. I'm just curious to get your insight into that.
Yeah, we actually did a very cool pivot. So we're in the same boat. We're not actually acquiring anything at the moment. Just things aren't penciling out for us. We're focused on kind of building our other business. So we're not acquiring right now either. However, we are still leveraging the heck out of our whole life policy through hard money lending. My husband has started dabbling in hard money lending, and he's turned it into this full-fledged business. And that's what we're using our policy for. And so it's just such a cool, like, wow, you talk about multidimensional tool. It's like, okay, we're pausing on real estate acquisitions right now. We're using it for this whole other new cool revenue stream. So that's been a very cool pivot we've personally taken, because we're in the same boat as just not acquiring right now. And for your listeners, Liz, I mean, I think that's okay too, to not acquire. I mean, if you're new to the real estate game, I think this is the time to build out that financial foundation. Save your money, get your budget in check, listen to podcasts, learn, analyze deals. This is the time for that, so that if rates come down, if the market shifts, you can then accelerate. So I think this is a really cool time for newbies, even if you're maybe not buying a lot right now. And then for, vetted real estate investors, this is a good time to maybe pivot and try something else, like we did with just kind of pivoting into a hard money lending type of deal.
I love that. We have a HELOC on our house, and we decided to not use that money for our own deals. We decided to lend that out to someone else. We're getting 12% a return. Now, at the time, it cost us 3%, which was lovely. That has increased to 6%. But even at that, right, we're still netting a 6% difference. I think the name of the game right now, and I'll just say, we did the same exact thing as well last year. We started a fund. We work with investors all over. They're working with us, and we're also doing a similar type of thing, lending that out. So whether you want to do hard money lending and you have so much to deploy, or you literally can lend to one person, I would highly recommend being mindful. Here's the tip. Be mindful of what's happening in the economy, what's happening in the real estate market, and the access to money. Because, for many people, they still need quick access to money, and they still need cheaper money from what they're getting because of interest rates being higher. So, I love that. I want to just give a quick shout out to Lend to Live. Is a great book published by Bigger Pockets. Two women wrote it, and it's all about how individuals can set themselves up for success for being private lenders. I recommend that a lot for people who are like, they may not have $500,000 to lend. They may have a certain amount, especially through their, whole life or what have you, but they want to set themselves up for success because it is something you need to do. And there's a lot of pieces of the puzzle, but it's not rocket science. So I recommend that as a tip. But I love that you're doing the same thing, Katie. And so I think that's the name of the game, is how you can still thrive without being as active if deals are not penciling out, because you could have a mix and be making, I'm making a return of 6%. Is it like 20%? No, but is it still making me money with an asset that I have? Yeah. And I'll continue to do that until the time is right for me to deploy that into something that's our deal. So I love that, Katie. Where can everyone listening learn more about you and connect with you further?
I'd love to chat with anyone. Send me an email, Katie at axiomwealthsolutions.com. Then we have a YouTube channel, Axiom_Wealth. So, we share some of these concepts and our own journey of, how we've gotten to where we are on that YouTube channel. We'd love to chat with anyone. Our mission is to help people build that financial foundation, because once you have a strong financial foundation, it just opens up endless possibilities for your family and the ability to live a really intentional life. And so that's what really drives us, is being able to help people with that.
I love that. And Katie and her husband were at InvestorCon 2023 last year. They're going to be at our conference this year.
With a 3-month-old, we're bringing our 3-month-old baby to this year's conference.
And that's all good. And that is all good. But what I love about Katie and all the interactions I've had with her and her husband and the support they've given to our community is that she just leads by education. She's done this, so what I love about what you guys do is you built a company around a strategy that you've employed yourself, and you're kind of one of us, if you will. So I just love what you stand for. Love this concept. I personally want to get more information myself, because you're making me think about my supercharged savings account. I'm like, oh man, I'm not making enough there. But anyway, so Katie, I have a few questions, our fabulous 3 questions I want to transition to here. What is the most transformational book you have ever read?
Oh man. I mean, I'll have to say that, the cliche rich dad, poor dad. I mean, I know everyone says it, but man, if you haven't read it, it does just get your mindset shifted. The second one is a book called Killing Sacred Cows by Garrett Gunderson. So it's 9 financial
I've
myths.
heard of that.
Yeah. And it's amazing because it's these 9 myths that we all grew up thinking are what you need to do. And he sort of debunks them and tells you why. So Killing Sacred Cows is a key one.
Put that on my list. So what is the most powerful routine you do to live a financially free and balanced life? Whatever balance means to you.
Easy. Annual strategic planning as a family. So something my husband and I started a couple years ago. Me coming from the corporate world of a W-2 job, every company does annual strategic planning, right? It's just what you do. But who does it for their own family or their own life? Very few people. And so we implemented that. So every year, my husband and I go away somewhere. This year we went to Sedona, or last year we went to Sedona. And we just hash out, what do we want life to look like in 5 years, in 10 years? What are our goals for next year? What's our financial picture? So, and if your kids are old enough, bring your kids along. Our oldest is 4, so he's not quite ready. But eventually, they'll be part of this annual strategic planning. And so, game changer.
I love that. It just side note, this is the first year I have a 6 and a 10-year-old. I felt like we could do vision boards together. So we did vision boards together. And that was so cool to do because we were just, my kids are funny with the things they're putting on their vision boards, but that's okay. It's a start and it gets them thinking. It's laying the breadcrumbs when they are ready to do this on their own. So I love that you do that and you'll, bring them into the loop. I love that you're bringing your 3-month-old to InvestHER Con. And then the last question, which women, famous or not, has inspired you the most?
So I'd say all the women who are going against the grain and kind of just breaking out and doing something different, Amelia Earhart, female astronauts, just those women who are just breaking the barriers are always kind of those that really inspire me. There's so many to name.
Yeah, I love that. I mean, you know the story of Amelia Earhart, and then you kind of revisit it and reread it, and you're like, whew, in a time that, women, there was so many limitations, right?
So many.
Katie, thank you so much for being on our show. I love your path. I love the tips and suggestions and really opening the door to another tool in the toolbox to not just create financial stability, but independence. So we can use what we have in front of us and leverage what we have. So thanks for being on the show. Excited to see you in June with your newborn. And thanks again so much.
Thank you. This was so much fun.